Welcome back to the Valuable Investor channel. Today, we are going to discuss the biggest topic in the world of finance, the Federal Reserve raising interest rates. I'll break down what it means for you as a consumer, the economy, and how it might affect your financial decisions. So let's dive right in. Before we get into the nitty-gritty of interest rates, let's quickly go over what the Federal Reserve is. The Federal Reserve, or the Fed, is the central banking system of the United States. The primary goal of the Fed is to maintain a stable economy by controlling inflation and promoting maximum employment. One of the ways they do this is by adjusting inflation rates. Why does the Fed raise interest rates? The main reason is to control inflation. When inflation is too hot and prices are rising too fast, the Fed steps in by raising interest rates. This makes borrowing money more expensive, which in turn slows down spending and helps keep inflation in check. How does this affect you? Let's talk about how this affects you, the consumer. When interest rates go up, borrowing money becomes more expensive. This means that if you're looking to take out a loan or get a mortgage, you'll likely face higher interest rates. Impact on the economy. The impact of raising interest rates on the economy can be both positive and negative. On one hand, it helps keep inflation under control and maintain a stable economy. On the other hand, it can slow down economic growth as businesses and consumers may cut back on spending due to higher borrowing costs. What should you do in light of the Fed raising interest rates? Here are 5 tips. 1. Review your loans and mortgages. If you have variable rate loans, consider refinancing to a fixed rate loan. 2. Reassess your investments. Higher interest rates can affect the stock market, so it's a good idea to evaluate your investment portfolio and make any necessary adjustments. 3. Save more. Higher interest rates benefit savers and hurt consumers. When lending is more expensive, those that overextend themselves get locked into higher interest rates. 4. Be cautious with new debt. As borrowing becomes more expensive, be mindful of taking on new debt. Make sure you can afford the higher interest rates before committing to new loans or credit cards. 5. Keep an eye on the housing market. If you're planning on buying or selling a home, be aware that higher interest rates can affect housing prices and mortgage rates. Stay informed and make decisions accordingly. Long-term implications. It's important to remember that interest rate changes are just one part of the larger economic picture. While the Fed raising interest rates can have immediate effects on your finances, it's essential to consider the long-term implications as well. A stable economy with controlled inflation is beneficial for everyone in the long run. So there you have it. That's a quick overview of the Federal Reserve raising interest rates and what it means for you and the economy. Remember to stay informed, make smart financial decisions, and keep an eye on how these changes might affect your personal finances. And as always, if you have any questions or thoughts, feel free to leave a comment below. Thanks for watching, and we'll see you in the next video. Happy learning, happy earning.